Rust Belt Capital is an elite Ohio-based private equity firm with a specialization in long-term, high-cash flow multifamily investments. If you're looking for long-term recurring income, you should check out Rust Belt Capital. From their approach to managing risk, to the locations they invest, the product quality they provide, this firm is serious about what they do, which is why the owners of Rust Belt Capital invest their money in every deal they take on. Review their case studies by visiting rustbeltcapital.com. That's rustbeltcapital.com. Once again, rustbeltcapital.com, or email investor@rustbeltcapital.com.
I like life insurance because it's very predictable, specifically whole life. It's predictable, and you have a very good idea of what's going to happen. If something is going to be wrong, overfunding, underfunding, overloaning, things like that, in a whole life policy, you can see it coming years in advance.
Hello, left fielders. Welcome to the Passive Investing from Left Field podcast. Our community is focused on networking and education to help people invest passively and think differently. Let's go.
This is Peter Kim, and you are listening to the Passive Investing from Left Field podcast.
I'm really excited today to have Jameson Lett with us. He is a wealth management advisor based out of Columbus, Ohio. His team has developed and refined a planning process that enables investors to better coordinate their financial decisions using comprehensive models that can help optimize cash flow, protect asset value, and build long-term wealth. He is one of the few financial advisors who encourages his clients to look outside of the standard Wall Street products and into the world of alternative investments. Jameson is an infielder. He's been a great supporter of LFI from the beginning, both as a sponsor and an attendee at all of our in-person events. But he is also an advisor to many in our community. So, Jameson, welcome to the Passive Investing from Left Field podcast.
Jim, it is great to be here.
Well, I'm glad we finally got you. It's taken a long time to get you on here. So, first question I always ask is, tell us about your financial journey. How did you become a financial advisor? How did you become involved with the left field investor community? How did you get into real estate? Let's hear your story.
Sure. Well, probably like most people listening to this podcast and elsewhere, I graduated from college and went straight into the workforce. So I was climbing a corporate ladder. And as I did so, I experienced this growing feeling of unrest. I didn't feel like my unique gifts or anything particular to my skill set was really being utilized in the role that I had. So as I was trying to figure out what I was going to do, I decided to make this exit from my W-2. You start looking at what you make, your family, thinking about long term, how long am I going to have to work and how much am I going to have to save. It just started to seem impossible, like I'd be stuck there forever. So now I didn't really think of myself as an entrepreneur, but I actually did have my first business of sorts when I was 11. And I don't know if you know this, Jim, I was a paper boy, and I don't even know if paperboy still exists. But as a paper boy, you collect the papers from, in this case, the Columbus Dispatch here in Ohio, and you go around, you distribute those to the customers, and you actually have to collect money from the customers. You pay the dispatch back, and you keep the profit. So at 11, I was making maybe 100, 150 bucks a month. I was feeling pretty good. But unfortunately, I spent all that on video games, so it didn't really get me ahead financially. But that was kind of my first taste of business ownership when I was just 11 years old. So fast forward to today, and you mentioned my team of advisors here in Columbus. We have colleagues within our firm that are scattered along the East Coast, and we do comprehensive wealth management. We manage those right field assets, which are, as you know, important for liquidity. And we broker insurance and annuity products as well. And we design financial models so that our clients can maintain a holistic view of their wealth and test drive their financial decisions before they make them. Comprehensive planning, I was talking with someone yesterday about this, really helps you shift from reactive to proactive in your financial world.
Well, tell me about that. What's the difference between reactive planning and proactive planning?
Sure. Yeah. I mentioned a conversation I had the other day, and we discovered kind of an issue. in their sort of financial plan. And I pointed it out, and they went back to their advisor and came back to me, and we were talking about it, and they said, well, if the problem comes up, then we'll deal with it then. And I simply asked this question to the person, well, is that the approach you want to take with in the rest of your life and with your financial decisions? It's really about, if we identify a problem, if we can identify something that we can see coming down the road, think of it like you're steering a boat, right? A small shift it makes it very easy to steer around an obstacle. But if you wait to the last minute, now you're slamming on the brakes, you're pulling the wheel to the left. So being proactive is about foresight. Now, I can't predict the future. I do not have a crystal ball. I use Monte Carlos and technology and tools just like everybody else who does what I do. But we build these models, and then we talk through. Our process is designed to find out those assumptions that our clients are making and then challenge them. I mean, some of them need to be challenged, maybe some of them don't. But that's what being proactive means, and that's why we talk about test driving financial decisions. If we're doing a comprehensive plan, we're going to build a model and we're going to run through scenarios. We click a couple buttons, we come up with scenarios, then we run through them to see, well, does our plan still work? And are we okay? Are we comfortable with the outcome if X, Y, and Z comes up? And then if it doesn't, are we comfortable with that outcome? Because the fact is, you can't predict the future, right? You never know what's going to be your issue. We just know the issues that people have, the stories we hear. And so we're trying to not just build wealth, but protect it at the same time.
Excellent. And one of my, I don't know if it's dislikes or beefs with the financial planning industry is that most advisors, they kind of ignore the alternatives. And I get it. I'm a former financial advisor, as you know, and that's because you don't get paid for the alternatives and you're not licensed for them. But, many, maybe most advisors don't even want to talk to their clients about that. But you, in your modeling, you can include the real estate or the syndications in the model when you're doing your projection. So that seems to me that's a much more realistic kind of projection. The only thing we know about the projections is that they will be wrong, but hopefully they're correct in the direction,
True.
but they're not going to be right exactly. So can you talk a little bit about how you can incorporate that in your planning, even though you're not recommending necessarily those investments, but you're just including them in your projections?
True. I want to be clear, and I probably should have started off with this, right? Not a tax advisor. I'm not an attorney. So tax, legal stuff, you want to go consult those professionals that you have with anything we talk about today. And even financial advice. Anything I talk about is not meant to be advice for you. Go back, talk to your wealth management advisor and see, if these strategies or things make sense for you. So that's the thing I probably should have said at the start. So we got that out of the way. When it comes to modeling, I always like to be clear. We're not vetting deals for clients. We're not permitted to do that. That's not something that we're going to do. But if you are investing as a limited partner, if you are a general partner, if you own a business, whatever it is, we can take that money-making activity and put it into our model. We can adjust how the cash flows are taxed. We can adjust the cash inflows, the cash outflows. So that's really it. I mean, not every system has that capability. We use a third-party system. There's two that are really popular that I've seen pretty much everyone uses, and the other ones I've seen aren't as good. If I find one that's better, maybe we'll make the switch. But it's really about the technology and capability of the model to input and to understand, it's more than just the products or the investments or the activity, but understanding the investor, the business owner. So a lot of times we have a plan. Most LP investors I talk to, Jim, have really done a good job thinking through their own cash flow and their plan up to about age 70 or 80. And that's when the plan sort of falls apart. And what I mean by that is a lot of the activity that you're doing as an investor or a business owner, you can keep doing it for a long time. But there's going to come a point Just like if you were going to work a W-2 job. What's that movie, Office Space, where the guy, I think it's Milton, he's in the basement, right? And they just stop paying him, right? So at some point, no one's going to pay you to show up to do your job. At some point, no one's going to trust you to make those investment decisions, right? We all get old. It happens. So what happens to your plan then? If you're used to generating certain types of returns as an investor, what's the plan when you can no longer do that? So we start building plans not just around the returns, but what about the taxes? A lot of people get used to this K1 real tax-friendly income. Well, how do we help that continue? Or if it doesn't, what is our backup plan for being in a higher tax bracket later in life when often expenses are higher, especially for medical reasons, long-term care expenses? When those things kick up, are you selling properties? Are you selling off parts of your business to cover those costs? Or do you have cash reserves? Are those cash reserves going to be taxable? Because the more money you take out to cover the expenses, the more you have to take out to cover the taxes. So there can be a multiplying effect. So a planner, it's definitely important to understand the intricacies of the products and the investments in the business and stuff that you're incorporating into the plan. But you also want to understand, the soft stuff, the lifestyle, the mindset, and the likelihood, the things that happen to all of us and that we all encounter. So I think any good planner can help with that part, but it's really marrying the two of that. And maybe we'll get into more of it later, but a limited partner has a mindset, I have found. Very similar to a business owner. That's why we talk about both of them in tandem. In fact, a lot of LP investor clients of ours are just business owners who've already had their successful exit, and that's how they got into investing.
Right. And, you talked about the LP mindset. One of the strategies that's quite popular in our community is infinite banking, or bank on yourself. Basically, cash value life insurance. So what's your take on that as far as implementing that for your clients?
Yeah, it's a very popular strategy. It's one I implement personally for myself as well. But I just like to start with, you threw out a couple buzzwords. These are marketing terms, right? They are hyping up a decades old strategy that utilizes a centuries old product. Okay. And I have nothing against marketing. Obviously, I'm here on a podcast. I have a website. I send out newsletters, right? Marketing is a good thing. You should do it if you own a business. But when it comes to terminology, I prefer to keep things a little more technical. I just feel like this helps people focus more on the meat and less on the sizzle, if that makes sense. So when we speak with our clients about cash structured life insurance, those terms I prefer, we use those terms because that's what it is, right? You start with a good mutual carrier with a strong dividend paying history, and you structure a whole life policy to optimize the growth of cash value over a specified period of time.
And who does this make sense for, and what are some of the things you need to think about when you're setting up these policies?
Well, I always start in the same spot, and it's the least popular component for most people that call in about this type of thing. It's the death benefit. And this is it's a professional conviction as a fiduciary, as a planner, but also personal for me, and that's protection first. If you have people who depend on your income, you need to insure that income. Insure it against death, insure it against a disability, something that would keep you from working. Don't leave that responsibility for your family to other people or to the state. And the reason, Jim, I share this, and I'll get off the soapbox in a second, but I meet these children, I meet these widows in my office, and you know what they ask? They never ask me about the strategy, right? Um, what they do ask me about is how much, how much death benefit. What am I going to get? Am I going to have to go back to work? Or is my family going to be okay? Will I have to make changes to my lifestyle while I'm figuring out what this new world looks like? So I always start there, and there has to be a need for the death benefit. You have to have evidence of insurable interest. So that's where I want to start. It's not the sexy stuff, but Very important. Protection first. As for the strategy itself, the differentiator is in the name, cash structured. So your average everyday whole life policy can take years to have any type of account balance, any cash value at all. So all we're actually doing, and again, this is nothing new, it's been around for a long time, is taking the innate benefits that you get with a life insurance policy, a death benefit, the tax treatment, guaranteed cash growth, non-guaranteed, although historically consistent, dividend payments, and we're structuring the policy to build cash more quickly. So while a typical policy would have $0 of cash value in the first year following your first premium payment, if you structure it for cash, you could have 70 to say 90% of your initial contribution within a couple weeks of setting up a policy, and that's accessible and available to you. So I think this is where people get stuck sometimes, Jim, and it takes time. If we're talking about like who is this appropriate for, it takes time to build up cash value in a policy, even if you structure it right. So I think for most of your listeners, this is the trade-off that you probably want to think about is when does it make sense to start diverting some of your cash flow into a policy? How long is an acceptable amount of time to wait for positive returns within the policy? And I think mindset becomes important here too. If you have more of an accumulation mindset, then when you're looking at a policy, it might not be as attractive because unless you have a very long time horizon, because it does take time to see positive returns in the policy. But people who tend to have more of a cash flow mindset, which I imagine is why LP investors and business owners, right, we're always thinking about cash flow. Then once you understand how to utilize policy loans, then the strategy really becomes a lot more attractive.
Right, and I think that's part of the issue, right? Is some people who are out talking about infinite banking and bank on yourself, they make it seem like in year one you're going to be able to use that cash for all kinds of investments, right? Like what I do is I use my cash value to invest in ATMs or other syndications, but it takes a while if you structure a policy properly. It takes a while to build that up, and I think a lot of people are anxious to get investing, so they want to just throw money in it and take it out. And I think the analogy that I hear a lot is when's the best time to plant a tree? Well, it was 10 or 20 years ago. Okay, when's the second best time? Today. And that's how I kind of look at life insurance, right? When's the best time to buy a policy? Well, man, I wish I bought one 30 years ago, but I'm pretty glad I bought one 10 years ago. And, for the next one, it's now. So we talk in this infinite banking about whole life insurance. And if people want to know all the details of whole life insurance, I don't want to do that on the podcast because I'll fall asleep, but talk about maybe some of the other types of life insurance and why you prefer whole life for this type of strategy, this infinite banking, or as you called it, cash structured life insurance.
I think that a good way to think about it, Jim, is a starting point, right? Think about the first investment you ever made. Chances are it was a mutual fund. Now, is that necessarily the best investment or the only place to put money? No. But when you're getting into life insurance, we often talk about it as a portfolio, just like anything else. You have a life insurance portfolio. Now, that might include term insurance, especially if you're young and just getting started. You've got kids and need a big death benefit. I carried piles of term insurance around for years because I had people who depended on my income. But is term insurance ideal? Well, it's like owning versus renting. So it makes sense for a time, but typically you want to own things rather than rent them. Term insurance, you're renting a death benefit. You can structure universal life insurance, another type of insurance, a lot of different ways too. Universal life insurance is decades old. Whole life insurance is centuries old. I like starting with something that's tried and true with a track record. And additionally, especially if you own a business or if you're an LP investor, you're taking on risk, right? Other places in your portfolio. Oftentimes, there's only a few things in your financial world that are a sure thing. there's only a few places you can have guarantees. So whole life is a contract that provides specific guarantees. So I always like to start there. If a whole life policy will do the job, it's going to have the most guarantees and the most flexibility for you. Some people like to use different types of policies. You take out guarantees, you can get more upside potential. It's not necessarily a bad thing. But again, if you're just looking at building blocks, right? Where do you start? That's why I like whole life insurance for that reason. And I'll just also say, sometimes I've seen if the returns aren't good enough in whole life, you can just sub in a different illustration with a different type of life insurance that illustrates higher returns. Illustrates. If it doesn't come through, and if the returns aren't as good, then the strategy might not work. And the only place I like life insurance because it's very predictable, specifically whole life. It's predictable, and you have a very good idea of what's going to happen. If something is going to be wrong, overfunding, underfunding, overloaning, things like that, in a whole life policy, you can see it coming years in advance. With other types of policies, especially if you don't know what you're doing, sometimes things can go south a lot more quickly.
And I think what you said is, like there's enough risk in our lives, in our business or our real estate, or if we're right fielders in our stock market and everything. If you're buying this permanent life insurance, right, which is the non-term type, then for me, I want to go with the guarantees because you don't get many guarantees in investing, and this isn't investing. And if you're putting money in whole life insurance, it's not really an investment, but it's reliable and it's going to happen. And I think and it fuels your other investments, right? My opinion, you can use it to fuel your other investments. So I think when I first looked into it, I was trying to juice the returns, right, by doing some of these other different kinds of products. And I finally realized, you know what? I'm going to juice my returns elsewhere. But then, when you're talking about whole life insurance and you go into the Google machine, be aware you're going to get a lot of different stuff. People either love this strategy and think it's the greatest thing on earth, or they are 100% convinced it's a scam and just a way for insurance agents to make a lot of money. So what's your take on that? How do you talk to someone who Googles life insurance or someone who just doesn't believe in it?
That's a great question. So, first, I guess right off the bat, Jim, if someone says, hey, I hate this thing, and then we say, okay, and that's it, we move on, right? Because that's just one tool in our tool belt. So we're not married to it. We like it, and we might ask someone, hey, do you want to understand why so many other people like yourself have implemented this strategy? And sometimes I'll volunteer, or why I personally do this. And most of the time they say yes, because most of the people we work with are naturally curious learners, right? That's kind of what it takes to become an LP investor, is that sense of curiosity and that desire to learn. And some people say no. I last week I had someone go like this with their hands as they said no, thank you, and we just laughed and said okay. And so we're going to show some other strategies for that person. It's not a big deal to us. We're not married to the solution. Um, and we take this pretty seriously. Like, it's not. It might sound cheesy, but it's probably on our website, our value statements and stuff like that. I remind other advisors who maybe get a little pushy with their sales and things like that, right? It's not your money and it's not your life, right? So I'm going to go home at night, and my team goes home at night. We sleep like babies, right? Because we know we did the best we could, giving the best advice that we could to our clients. And at the end of the day, the person on the other side of the table, your listeners, they have to go to bed at night knowing that they've done the best they can for themselves and their families, right? That's all of us are just trying to do the best we can, right? And so I think if you really have that mindset, you don't become the pushy life insurance salesman, right? You can be the advisor who comes alongside the client and helps them, because at the end of the day, they will live with their decisions. I will advise there's very few things I advise everyone the same on. But if I'm going to be general, every 20 something who gets their first W-2 job should have long-term disability insurance. One of the most boring financial instruments out there, but that's a pretty solid blanket recommendation. If they say no, Either way, right? If they say yes or no, they have to live with either paying that premium every month, which might suck. I don't like paying mine, or living with not having the coverage and something could go wrong. And statistically, they're more likely to be fine than not. So I don't have a crystal ball. I can't predict the future. That's just an example, but I think that's when you get the pushy salespeople in my industry, which they exist. I think they don't have this mindset, or they just don't have the ability to do anything else, so they're actually losing revenue, which is a different problem.
Yeah, I think that mindset is important. I think part of it, when I was a financial advisor, I was just so confident that I could help someone, and when they didn't want to use the tool that I had to help them, I was just kind of lost. Like, why wouldn't you do this awesome, great thing? And you're right; they just had a different approach, and that's probably why I wasn't a very good financial advisor, because I was just so happy to help someone and be like, look, this is the best thing for you. But sometimes you don't know the best thing for other people. So I really appreciate that mindset. And that's probably why you're still in the business and I'm not. But so in addition to,
I was going to say too.
Oh yeah, go ahead.
I'll just throw one more thing out, Jim, in terms of belief. Obviously, there's tons of resources out there. There's people who know how to do this stuff you can talk to. Get educated and look at it for yourself. But when it comes to this strategy and why so many people like it, the reality is there's just very few places where you can park your money, earn a competitive risk-adjusted return, and at the same time have those funds deployed elsewhere, earning an additional return, right? So if you're going to take a loan from your 401k, for example, if you've got $100,000 in a 401k and you take a loan of $90,000 out, they're going to move $90,000 into cash. So you're not earning multiple rates of return. And that's really, if I'm summing it up in a nutshell, that's why people look in to a cash structured life insurance policy. Is you start with this unique feature in non-direct recognition of policy loans. And then when you wrap around the innate benefits, the tax benefits, there's loans are not income, so there's no taxes typically, right, on a loan to yourself. Because it's life insurance, so I think Section 7702 means cash values will grow tax deferred, so there's no taxes when the dividend's paid out into your policy. And so you get this tax deferred growth, policy loans that are tax free, and a competitive, again, risk adjusted return. There's no market risk. Part of the return's guaranteed, and the part that's not guaranteed, you can look at, there's a number of companies that have been paying dividends for 150, 160, 170 years without missing one.
No, that's how I use it. Multiple returns on the same dollar. You can't beat that. Left Field Investors is a community dedicated to limited partner investors who are interested in building wealth through real estate investing. The community is focused on education, networking, and engagement with quality operators and partners. We provide tools, webinars, and a forum where members can discuss everything related to real estate investing, including deals, operators, investment strategies, and much more. Coming soon, we're adding a new tool, Sponsor Reviews. This will be a place where our members can rate and review operating partners to further help each other in our investment journeys. Check us out at leftfieldinvestors.com. Visor provides investors with a secure platform that displays a comprehensive view of all of their holdings on a single, holistic dashboard. From real estate syndications to private equity, crypto to traditional investments, with AI-driven, unbiased, honest insights to maximize return. Visor is your one place to rule them all. Automating performance tracking, projecting future cash flow, analyzing all your financial documents, and much more in one powerful solution, making it easy to follow the money. Sign up for a free 30-day trial now at Visor.co. We talked a little bit about how you work with limited partner investors. You work with a lot of people in our community, but you also work with business owners. So what's the difference when you're working with a business owner compared to, say, just an investor?
Yeah, sure. There's, a lot of similarities. A business owner and an LP investor, very similar mindsets, right? So we were just talking about that. But when it comes to a business owner, right? So if you're a solopreneur or you have an assistant, okay, then maybe it's not so different. But when you're talking about 50 or employees, 2,000 employees, things can get pretty different. So, and this is why my team is part of a larger firm, First Financial Group. We have decades of experience in advanced business and estate planning. So, when it comes time for a creative exit or tax strategies, benefits administration, a 401k plan design, all that stuff, we're able to pull from a really deep roster, and that's the whole reason that we exist as part of a larger firm. Um, our engagements with business owners typically, Jim, will start with something mundane like benchmarking a 401k plan, or if someone, I mean, there are studies on this. 98% of business owners don't know the value of their business. So we'll do an informal valuation as part of our planning process. A lot of people, they have an operating agreement. In that operating agreement, there are buy-sell provisions. And I can't tell you how many times I meet with a business owner who doesn't have them funded. In other words, the language is there that says owner A buys out owner B, but where does owner A get the money to buy out owner B? Most people don't have that much reserve sitting in cash, right? You've got payroll and other stuff. So, but if I think, Jim, if I'm going to plug our business planning in one way, I think I would probably just put this spin on it right here, and that is, right, we talked about cash flow. Cash flow is very important. And when we're working, or let's say you're preparing for an exit, right? So you're going to get probably some multiple of your EBITDA, right? So let's say you've got $1 million of net income and a 7 multiple. That's a $7 million business. Well, if we can go through and by coordinating the different aspects to your business, the insurance, the taxes, the benefits, and all of those things, if we can find through optimizing those different pieces, creating more efficiencies, we find $300,000 of net income. That hits your bottom line. So now instead of a $7 million exit, you have a $9.1 million exit, if that makes sense. So that's really the power of comprehensive planning that's unique to the business owner, is that you're going to be talking about these multiples, exits, and just more components. So we take the same approach, comprehensive and holistic, but with a business owner, there's just so much more that we can dig into, and that's where we pull in more team and more expertise.
You know, in our community, Left Field Investors, we spend a lot of time, as you know, vetting sponsors and talking about how to decide if I want to invest with someone or not. And we're trying to transfer that skill into other areas of our investing, right? So how to financial advisor, how to find a tax person, how to find a CPA. So, you know, most of our community invests in real estate syndications, right? That's why they're part of the community. So is it important to work with an advisor that invests in real estate or alternatives or syndications as well? Is that should that be part of the screening process when I'm trying to find someone to work with?
Yeah, I think it could be for sure. I mean, usually when you're finding an advisor, you want someone who understands your unique situation, right? So I think that's certainly going to be a benefit if that advisor personally invests and works with other people like you, right? And you know, an advisor has their own financial world, so their stuff might look different than yours, and they shouldn't necessarily be the same because everybody's different. But I always think that's a good starting place, is starting with people who understand you, they understand your community. I also think it's important to work with advisors who do comprehensive work, right? So I think most people are good people, but also we're all humans and we all have incentives around money, right? So if an advisor is compensated in one way only, then there's always going to be some misalignment of the incentives between you and that advisor. So a big thing for us that we are very proud of is that we, in a sense, let our clients kind of choose how they want to engage with us, right? If you just want advice for a fee and you feel like that's the right path for you, that's what we do. We have clients who would never pay a fee for advice in a million years. They think it's antithetical to like everything that America stands for or something. You know, it's very deeply held belief. That's okay too. we're not going to do all the extra comprehensive work if we're not going to get paid for it, obviously, but we can still design a strategy for you, right? Because if it's like we talked about cash structured life insurance, well, you probably know those insurance carriers pay commissions. They're going to pay them to someone. Work with us, they'll pay us the commission. If we're doing some other alternative, right, we have a fee for asset management if you want to hire us to be your asset manager. So our clients can choose how they want to work with us. I think that's also an important aspect, Jim, just because, well, the old saying, right? If all you have is a hammer, everything looks like a nail.
Yeah, and I appreciate that because that makes complete sense to me, and I think that gets wrapped up sometimes in this, talking about a fiduciary. So I want to know, is that something that you think is important to make sure that your financial advisor is a fiduciary? And before you answer, I'll tell you kind of my opinion, which some people don't really like. But the way I look at it is, yeah, you could be a fiduciary and take all those classes, and that's great. But if you're going to steal money from me, you're going to steal money from me whether you took all the fancy classes or not. So for me, I don't really think, I want my advisor necessarily to be a fiduciary. I appreciate that they took all the extra classes and learned a bunch of stuff. But my philosophy is that just because you have that check mark doesn't mean that, okay, you're much better than the advisor standing next to you who doesn't. So can you address that a little bit?
I mean, to your point, Jim, if you just think about it, it's not like you can take an unethical person, let them pass a test, and all of a sudden they become ethical. That's not how it works, right? So it's a question I get a lot. I do think it's a good question. I think it's probably good to have on your, checklist of things when you're working with someone. But there's also a lot of misconceptions around it. If we talk in our industry about when you're acting as a fiduciary. So it's not even are you one, it's when are you acting as one. When I do a life insurance policy, I'm not acting as a fiduciary because I'm acting as a agent. So it's different. Now, we don't have to get all into it, but the language is around best interest. Fiduciaries have to do what's in the best interest of a client. Well, outside of the fiduciary standard is suitability. So you have to recommend things that are suitable to people. So can you explain the difference? Most people can't, and I would submit that there are differences. I think particularly around like legal liability that you can hold, the fiduciary more liable or something. But I think if that's your starting point, then it's probably not a great relationship, right? If you're thinking, well, can I sue this guy if this doesn't work out? I mean, then maybe you need to talk to someone who you feel a little more comfortable with. The bottom line, I think, is that it's a good question to ask, but like you said, it is not a fail-safe.
I like that answer. That's well said. The last question I always ask is, what's a great podcast that you like to listen to?
I knew you were going to ask this one, Jim, and I wanted to go through and look at what am I listening to most recently. So I'm going to throw out two. First is Hard Fork. Hard Fork is a podcast on. It keeps me. I'm not a tech guy, so for me, Hard Fork keeps me sort of like, in the game from a technology standpoint with what's going on and the ramifications. I also have kids who, like maybe all of us remember when we were out teching our parents when we were younger. My kids are getting to the age where they're starting to out tech me, so I gotta like stay in the game there. And then, you know what? I'll do a hardcore history. I'm a big history guy, and sometimes on the weekend I need to unplug from all the financial stuff and the economics and everything. And so when I want to do that, I'm always up for a good long history podcast.
Excellent. Well, thank you for those recommendations. So finally, if listeners want to get in touch with you, learn more about what you do, what's the best way to do that?
Probably the best way is to hop on my website. It's just my name, jamesonlett.com. From there, you can schedule time on my calendar for a quick call, get in touch with me, someone on my team, check out some of our resources, dig into First Financial Group and the firm, all that stuff.
Excellent. We'll put that all in the show notes. And Jameson, thank you so much. This has been fantastic. Appreciate you.
Thanks, Jim. Thanks for having me. It's great.
Investing in syndications can be a daunting task. Wiring a large sum of your hard-earned money to someone you talk to on the phone for 30 minutes can certainly be scary. How can you be confident in what you're doing? Steve Sue, one of the founders of LFI, just published a book called Avoiding Rookie Errors as a Left Field Investor. 20 lessons learned from 14 years of investing in private syndications. This is by far the best book I've read on syndication investing. It's an easy-to-read book, chock full of great advice from Steve's experience as a passive investor. It is a must-read. Whether you're a first-time passive investor or a veteran, go to www.leftfieldinvestors.com/books and click on the link to Avoiding Rookie Errors as a Left Field Investor. If you are a passive investor, you got to read this book. Have a deal in mind and a group of investors ready to go? Use TribeVest to pool your capital together through a multi-member LLC. TribeVest has streamlined the group investment process, making it easy, quick, and safe to do business with others. Start a tribe and invite your partners to join. Then you can use the platform to collaborate with your partners, pool capital, and manage your joint investments. I'm in 12 tribes myself. It is a great way to learn from others, spread risk, and get into deals at lower minimums. Go to tribevest.com to get started today. It was great having Jameson on the podcast. He has been such a big supporter of LFI at every event and just has been there for the community. So it was really nice to have this conversation with him. A couple of things that stood out in that conversation is he's talking about comprehensive planning and the importance of it to include all of your assets, not just your stock market stuff or whatever, but everything. And he talked about being proactive rather than reactive. And that's really the way we should be in all of our planning, right? If we're doing tax planning, estate planning, or financial planning, we need to be proactive and not just be reacting to things as they happen. And it's difficult because sometimes we don't think of these things as important, or they are important, but they're difficult to do. So we put them off. I know I do. And so being proactive is just so important. And, Jameson talked about he's not going to vet real estate deals for you, right? He's not licensed for that. That's not his expertise, but he does include it in his projection models that he runs. And so when you're finding a financial advisor, it's important to make sure that they are willing and able to include some of your real estate investments in their overall plan, because otherwise you're just having your financial advisor look at part of the picture. And to give you an appropriate plan, they need to be able to look at and understand the full picture. And so that's why it's important that you find someone that is affiliated with real estate. And he also talked a little bit about the difference between a financial planner and an insurance agent. And there's pluses and minuses, right? An insurance agent, what are they going to do? They're going to sell you insurance because that's what they do. So if you know that's what you want, then you can talk to an insurance agent. But a financial planner can do the insurance and might have an overall view of your portfolio that might be helpful and might inform some of the decisions you make on the insurance side. So I think it's important to have an understanding of that at least. And then when you're talking about life insurance, Jameson said protection is first, right? Because if something happens to you, we don't like talking about it, but it's going to happen to all of us. You want to make sure your family's protected. And so, when I'm talking to agents, most of them just want to talk about all the amazing cash value that they can provide in those policies, but you have to consider the full product. You have to understand how that product works. And that all comes down to the most important thing, whether you're picking a financial advisor or an attorney, you need to find the right one for you. Don't be pushed into something that you don't know or don't understand or don't want to invest in, right? If you're just totally against life insurance, I'm a big believer in it, but if you're totally against whole life insurance, and you talk to an advisor and they're pushing, then you're in the wrong place, right? Let them educate you and talk to you about it. But if you're still a no, then be a no. And if your advisor is pushing you in a way that's uncomfortable, then you might not be with the right advisor. So I think it's really important for all of the advisors that we have in our financial world to make sure that they are meeting us where we are, educating us on things that we don't understand or need more information on, and then listening to us when we're comfortable moving forward, and also more importantly, listening to us when we're not comfortable moving forward. So again, really enjoyed Jameson and appreciate him as a valued member of the Left Field community. That's all we have for this time. We'll catch you next time in the Left Field. Thanks for hanging out in the Left Field with us today. If you're interested in becoming a left fielder, you can find us on the World Wide Web at www.leftfieldinvestor.com and click the subscribe button to join our community. If you enjoyed the podcast, please subscribe to the show on your podcast player so you don't miss an episode. If you really enjoyed the show, A review on Apple Podcasts or wherever you listen to the podcast would be appreciated.
This show is for entertainment purposes only. Nothing said on the show should be considered financial advice. Before making any decisions, consult a professional. This show is copyrighted by Passive Investing from Left Field and Left Field Investors. Written permissions must be granted before syndication or rebroadcasting.